Okay, everybody, this video might be a little bit boring, but I wanted to show some evidence of a claim that I made in a previous video. I basically said that high volatility means that options pricing will be high. So I wanted to show y'all some proof that my claim is true. So please don't believe everything that you come across on the internet. Make sure the people that you learn from are all willing to provide some kind of proof of their claims, myself included. There's a study that I did just for the channel. I do it normally anyway. But you could do yourself if you got the Thinkorswim desktop platform and one of my favorite sources for individual symbol volatility, and that's optionseducation.org. So let's look at some study criteria. These are the parameters that we're going to be using to make for a really good and accurate study, as accurate as we can be. We're going to use the same symbol, of course. So we're going to, in this case, we're going to use Tesla. We're going to choose options pricing on one high volatility day and options pricing on a low volatility day. We're going to compare the two. We have to choose the same expiration for both because that is factored into pricing as well. The same exact days. We're going to use the same exact amount of days. And we'll also use the same probability. You can use in the money percentage, but we're going to use out of the money percentage for this study. There's a recap of those terms below, but I won't go through those. You can read them on your own if you would like. But the out of the money percentage for this study is basically the percentage chance that an option is going to expire worthless. So I chose these parameters so that we can compare apples to apples. Like we couldn't just use the same strike price across multiple dates. Like we can't choose the 300 strike on the high volatility day and a 300 strike on the low volatility day because the share price is different on both of those days. So to level the playing field, we want to assess the same amount of risk on both of those days. So we're going to try and get the same exact out of the money percentage. That's where that one comes in, especially in the symbol and the days to expiration. So we just want to compare the same amount of risk on a high volatility day to the same amount of risk on a low volatility day. I hope that makes some sense. So let's go to the Options Education's website, and then we'll go to the Thinkorswim platform after that. So this is the Options Education website. I'll go back to the home page so that y'all can see how I got here. Optionseducation.org. Click on the magnifying glass. Go to historical and implied volatility. For the symbol, we said Tesla, right? Let's go to Tesla. And we're going to notate these 2 days. We got June 22nd and we got September the 14th. Now that we got those 2 days, let's go to the Thinkorswim platform. We're going to go to main page and we're going to go to the Analyze tab and then we're going to go to Think Back. So now let's bring up our spreadsheet and I'll show you that I've already pre-filled this in because I knew that I was going to be doing this. We're going to look at this probability out of the money percentage. Look at that. Look at the expiration date. That's 38. Look at the trading day, that's 622. That's exactly what we wanted. This is our low volatility day. That's why it's highlighted in blue. Okay, so I hope you guys can see that pretty well. Now, let's go ahead and see and make sure that these prices are accurate. Make sure that I didn't goof when I was putting in the prices. So let's go to 22%. 21.86 is the closest. We need 90.85 for the bid and 93.20 for the ask. So 90.85, 93.20. The mid, if you look at the formula, it's just 1 plus 2 divided by 2. That's how you get the mid price anyway. And then to get this number, you're going to do the high volatility day minus the low volatility day and then divide it by the high volatility day. That's how you get this number here. So let's continue. Let's just look at the 80% to make sure I got the right numbers because we're going to use those on another slide. Let's scroll up to the 80%. 80% is right here. That's the closest one. It should be the 510 strike, 510 strike. So our number should be 1020, 1055, 1020, 1055. Great. So now let's do the same thing on the call side. On the call side, let's look for our 22, 12, 22, 65, 13, 150. 12, 22, 65, 13, 150. Now let's go to the 80. Let's go to our 80. I passed it. I think it's this one. It's 710. Yep, 710 strike, 1400, 1325, 1400, 1325, 1400. Great. Now let's choose our next trading day. That was September the 15th. And even though on the screen, somebody may notice that September 14th was the 52-week high, I went one day later, which the volatility was a little bit lower. I went one day later so that we could have this right here, 38 days till expiration. Remember, we got to have the same days till expiration. So let's bring back up our spreadsheet. Oh, click the wrong thing. There we go. So now let's look at our 80%, 30-75, 35-20. 30-75, 35-20, and let's go to the put side. 22%, 14-475, 14-840. 14-475, it's 22.9. Oops, let's go back. If I got a mistake, then I would love to fill it in. It's a 560. It's a 22%. Oh, I'm on the wrong one. Let's go to puts. There we go. 14-475 and 14-4-840. I was going to say, I thought I did this right. I'm glad to see that I didn't mess up. Okay, so the 80%er is 1050, 1070. 1050, 1070. Remember, this is the high volatility day, 9:15. Last one, let's look at the call side, and then we can move on. 22.52% out of the money. Let's see that price, 15-520, 16-110. 15-520, 16-110. Boom, our numbers are correct. So these numbers are correct as well, because that's where the percentage is coming from. Lower out of the money percentages represented, this is a 20% difference. The high volatility calls that were low out of the money percentage were 20% more expensive. And on when volatility is high, the lower, this is great. I mean, the higher out of the money percentage options were 59% higher. That's huge. And you got 37% for the low out of the money percentages for puts, and only 2% difference for the high out of the money percentages for puts. So let's get back to our slideshow and get ready to close this thing out, because I think I've been talking long enough. Okay. So what did we just confirm? As I said before, higher volatility means higher options prices. Ultimately, it could be best to purchase options when the volatility is low. Everybody, can probably figure that out just from the study. But let's just address some maneuvering for when volatility is high, and then we'll end the presentation. And the reason why I want to address some maneuvering for when volatility is high is because it's easier to win and do well when the volatility is pretty low, because there's not as much fluctuation or movement. That's all. And still, you can't predict the stock market, but because the moves aren't large, it's hard to really get blown out of any one position. So let's move on. I won't read through every single thing word for word, but basically for put contracts, the lower the out of money probability, the lower the chance for the option to expire without value or to be worthless, the greater the percentage difference between high and low volatility options prices. Remember, the 22%er for the high volatility was 37% more expensive than the 22%er in the low volatility environment. And the 80% put was only 2% more expensive. Now, why is this relevant, useful information? If you're a buyer, you want to buy things that are relatively cheaper, right? A seller wants to sell things that are relatively more expensive. So when you buy high out of the money puts, remember, we're only addressing high volatility environment maneuvering. Amidst high volatility environment, it's not that much more expensive than when the volatility is low. It's only about 2%. So that's why you want to see the example above. But if you're a seller, I mean, the 80% example, remember, only 2% more expensive. But if you're a seller, the low out of the money puts, that's in this 22% example, amidst high volatility are more attractive because the low out of the money puts, low 22%, are much more expensive than when volatility is low. This is the 37% more expensive when that volatility is high. So that means, like I said, when you're a seller, you want to sell things that are relatively more expensive. And granted, look, that doesn't mean choose these exact percentages, but it just might alter which out of the money percentage you get closer to, depending on what volatility is doing. For call options, it's a little bit different. The lower the out of the money probability, the smaller the percentage difference between high and low volatility options. The 22 percenter was only 20% more expensive than the 22 percenter in low volatility environment. And the 80 percenter was a huge 59% more expensive than the 80 percenter call option. And remember, this is an 80% chance that this thing is going to be worthless. But the amount that it costs it's insane. It's a huge, huge uptick in price, 59%. So look, if you're a buyer and you want to buy things that are relatively cheap, a seller wants to sell things that are relatively more expensive. So when volatility is high, it's cheaper to buy those lower out of the money percenters. Boom, 20%. Remember, we're only talking about maneuvering during high volatility. But for sellers, the high out of the money puts, boom, the ones that have a good chance of expiring worthless. That's what a seller wants. They're more attractive because they are more expensive than when volatility is low. They're more expensive than the 22 percenters, the higher ones. And remember, again, that does not mean choose these exact percentages that you see. It just might alter which one you choose depending on when volatility is high. Remember, we're only addressing when volatility is high. And that is actually it for the video. Sorry that this one went a little bit long. If that was a bit overwhelming, just please come back and watch again later as your experience grows. And thank you for watching. No fluff here. Enjoy your day. Thanks for watching.